Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Now that you've learned a little bit about rights and warrants, let's take a look at a question that involves both to better understand the type of question we might see on the actual exam. If you want to, feel free to hit pause in this video and see if you can answer the question first. Go ahead and do that now. Okay, hopefully you feel like you have a right answer. Let's go ahead and jump in and pick this apart and talk about it together. A publicly traded company offers their shareholders a short-term security that allows them to purchase their stock at a price lower than its market value. And they want to know what type of security it is that they're talking about. This is a pretty straightforward question. There's not a lot put in here that's meant to throw us off or to confuse us in any way, but there are a few nuances in this question that we definitely need to pay attention to, like the fact that we're dealing with a publicly traded company, that they reference a short-term security, and that security will allow a purchase of shares lower than what their current market price is. All three of those are things that we need to pay attention to make sure that we match it up with a product that meets those specifications. Let's go through each answer here to see if it fits what they're looking for. Now, first, we have warrants. As you learned, warrants are long-term rights to buy a stock at a fixed price. A lot of the time, warrants are issued as a sweetener with a bond offering, and initially when they're created, they allow a purchase of stock at a price that's not necessarily good at that moment. Another way of saying that they're issued without intrinsic value. For example, a warrant may allow you to buy stock at a price of $60 a share when it's currently trading at $50 a share. Now, right away, that doesn't make any sense at all to use that warrant, and it really doesn't match up with what we're talking about in this question. And really, the only thing that makes a warrant valuable is the fact that there's a lot of time associated with it. We call that time value. If the market price of the stock were to rise above 60, say to 70, 80, 90, now that purchase price of $60 seems a lot more affordable, a lot better, and it's just a good deal overall when that happens. Regardless, when warrants are issued, it does not match up with what they're talking about here. It doesn't allow the purchase of stock at a price lower than its market value, at least when it's initially purchased. So A is likely not going to be the answer that we're looking for. It's very similar, very close, just probably not it. Let's go to B, a call option. If you're going through this material in order, then you haven't learned about call options yet. A call option is a contract between two investors that allows the purchaser of that contract to buy stock at a fixed price. You could easily find a call option in the market that would allow you to buy the stock at a price cheaper than what its current market value is. And that certainly matches up with the end of the question. You will learn more about this in the options chapter, but the problem is that options are not created and issued by the company that it covers. For example, if we're talking about McDonald's does not issue its own options. Options are created and issued by an organization called the Options Clearing Corporation, also known as the OCC. So just because call options are not created by the issuer themselves, that doesn't match up with the beginning of the question. Publicly traded companies don't create these. They're created by another party. Therefore, B is likely not going to be the right answer. Going on to C, we have rights. Rights come from something that we refer to as the preemptive right. and that is one of many rights that shareholders have. The preemptive right allows current shareholders to maintain their same proportionate ownership of the stock if the company decides to sell more stock to the public. Now, what does that mean in plain English? If the company wants to issue more shares of stock to the public that it hasn't yet sold, they have to give the right to their current shareholders to buy those shares first. That is what the preemptive right is. When an issuer decides to sell more shares of stock to the public, they hand out these rights to their shareholders, and they want to raise that money pretty quickly. Therefore, rights are typically very short term, and they're usually issued with 30, 60, or 90-day maturities, but they're usually just a few months maximum maturity, and that's it. So, this is a very short-term security issued by publicly traded companies when they decide to sell more stock to the public. So therefore, it does meet the first two characteristics. Now, looking at the third characteristic, does it allow the purchase of stock at a price lower than what its current market value is? The answer is yes. Rights have intrinsic value when they're originally given out by the issuer to its current shareholders. Intrinsic value means immediate value. As an example, the issuer might allow you as a current investor to buy its stock at 40 when it's really trading in the market at 50. The reason why issuers do this is because they're trying to create an incentive to their current shareholders to buy the stock directly from them so that they don't need to hire an underwriter to sell the shares for them, which would likely cost them a significant amount of money to do so. No pun intended, but rights seem like the right answer here. It meets all three characteristics: issued by publicly traded companies, short-term investments, and they allow the purchase of stock at a price lower than its market price, another way of saying it has intrinsic value. Even if C feels like it's the right answer, I would still go on to D and just talk through that and make sure that that's definitely not the right answer. The reason is that FINRA could give you a question that has more than one right answer. It doesn't happen that often, but it's very possible that it could happen to you once or twice on the exam. And in that case, it's your job to figure out which answer is the best of the two or the three that you think are potentially right. So let's look at D and just make sure we feel good about our answer. Convertible preferred stock is preferred stock at its core. And if you remember, preferred stock is a type of stock that pays a continual fixed dividend to its shareholders. Investors typically purchase preferred stock to gain access to a consistent flow of income. Preferred stock pays continual dividends to its investors, and even though that's not important for this question, just something to think about a little bit as we make our way through this question. The important term here is the term convertible. Preferred stock could be converted into common stock at any point in time by the person that bought that preferred stock. Now, the thing is, preferred stock in itself is not a short-term security. A lot of times, investors hold preferred stock in their account for years or even decades, and there's really no end date to a preferred stock unless maybe it's callable, which means the issuer would be able to pay that money back to its investors and just end the investment when they decide to do so. But the bottom line is that preferred stock itself is not a short-term security. So that doesn't meet one of the three important characteristics that we need it to meet. Because of that, it's probably not going to be the right answer. Also, convertible bonds just convert straight over to the common stock. There's no need to buy that stock at a fixed price, so that really conflicts with the third characteristic as well. It just converts over to stock whenever you feel like doing that, and you have the ability of doing that as soon as you purchase the preferred stock in the very beginning. Bottom line, two of our three characteristics are just not met. Therefore, there's no way that D could be the right answer. And sure enough, C is the right answer that we're looking for. Rights are short-term securities issued by publicly traded companies that allow the people that receive those rights to buy shares of stock at a price lower than its market price, also known as intrinsic value.